You know, I've been investing for over 7 decades now, and I've seen my fair share of storms, the kind that wipe out fortunes overnight, and the kind that create generational wealth for those who see them coming. But what's happening with silver right now? Well, this isn't just another storm, this is the storm. And I'll tell you something that might shock you. It's already started, and most people are completely blind to it. I've always said that the best time to buy is when there's blood in the streets. But here's the thing right now. There's a different kind of opportunity. It's not about blood, it's about blindness. The world is so focused on AI stocks, cryptocurrencies, and the latest tech sensation that they've completely missed what's building up in the silver market. And let me be clear, when this wave fully hits, it won't just be big, it'll be biblical. I didn't build Berkshire Hathaway into what it is today by following the crowd. I did it by seeing what others couldn't see. And right now, when I look at silver, I see something that reminds me of the greatest opportunities of my lifetime. Let me explain why. Now, before I get into the specifics of silver, let me tell you about a principle that's guided every major investment decision I've ever made. Understand what you own and own what you understand. Simple, right? But you'd be amazed how many people violate this basic rule every single day. Silver is one of those assets that people think they understand, but they really don't. They see it as poor man's gold or just another precious metal. They couldn't be more wrong. Silver is fundamentally different from gold, and understanding this difference is the key to understanding why we're standing at the precipice of something enormous. Let me paint you a picture. Gold is primarily a monetary metal. It sits in vaults, it backs currencies, or used to, and it serves as a store of value. About 90% of gold is used for investment and jewelry. Silver? Completely different story. Over 50% of silver demand comes from industrial applications. We're talking about solar panels, electric vehicles, electronics, medical equipment, water purification systems, the building blocks of our modern world. Here's what most people miss. We're living through the greatest industrial transformation since the electrification of America in the early 1900s. The green energy revolution isn't coming, it's here. And silver is the unsung hero of this revolution. Every solar panel requires about 20 grams of silver. Every electric vehicle uses 2 to 3 times more silver than a conventional car. 5G infrastructure loaded with silver. The electronics in your pocket, your computer, your car, all dependent on silver's unique properties. You see, silver has the highest electrical conductivity of any element, the highest thermal conductivity, and the highest optical reflectivity. In technical terms, it's irreplaceable for many applications. Sure, manufacturers are always trying to find substitutes to save costs. I respect that. It's what I do, but for most high-performance applications, there simply isn't a viable alternative. Now, let's talk about supply, because this is where things get really interesting. The world produces about 1 billion ounces of silver per year. Sounds like a lot, right? But here's the kicker, we're consuming more than we're mining. The Silver Institute reported that industrial demand alone has been exceeding mine supply for several years now. We've been making up the difference by recycling and drawing down above-ground inventories. But those inventories? They're dwindling fast. I've always believed that the most powerful force in investing is supply and demand. Not sentiment, not momentum, not what some talking head on television says, just pure, simple supply and demand. And right now, we're heading toward a supply-demand imbalance in silver that could make the oil shocks of the 1970s look tame by comparison. Let me give you some numbers that should wake you up. In 2000, the world consumed about 850 million ounces of silver. By 2024, we're consuming well over 1.2 billion ounces annually, and that number is accelerating. The International Energy Agency projects that solar panel installations alone will require 85 to 98 million ounces of silver per year by 2030. Electric vehicle production is expected to account for another 88 million ounces by 2030. Do the math with me here. If just these two sectors, solar and EVs, account for nearly 180 million additional ounces of demand, where's that silver going to come from? Remember, total annual mine production is only about 1 billion ounces, and it's not growing. In fact, silver is often a byproduct of copper, lead, and zinc mining. About 70% of silver comes as a byproduct. So when base metal prices are low or mines become economically unviable, silver production drops even if silver prices are rising. This is what I call a structural supply problem. It's not something that gets fixed overnight. You can't just flip a switch and open a new silver mine. It takes 10 to 15 years to bring a major mining project online, and we're already behind the curve. Now, I've been in this business long enough to know that markets can stay irrational longer than you can stay solvent, as my friend John Maynard Keynes once said. But I also know that fundamentals always, and I mean always, win in the end. The market might ignore these supply-demand dynamics for months or even a couple of years, but it can't ignore them forever. What we're seeing right now is the early stage of what I'm calling the silver storm. It's that period before the hurricane makes landfall, when the smart people are boarding up their windows and stocking their shelves, while everyone else is still at the beach enjoying the sunshine. The really fascinating part, and this is where my decades of experience really matter, is that I've seen this pattern before. Not with silver specifically, but with other commodities and assets. I saw it with oil in the early 2000s. I saw it with certain stocks during the dot-com bust. There's a pattern to how these things unfold. First comes the fundamental shift that most people don't notice. Then comes the gradual recognition by smart money. Then comes the rush by institutional investors. And finally, usually too late, comes the retail stampede. With silver, we're somewhere between stage 1 and stage 2 right now. The fundamentals have shifted dramatically, but most investors are still asleep at the wheel. The smart money, and I'm talking about some of the most sophisticated investors in the world, is starting to position itself. But the general public, they're still chasing AI stocks and meme coins, completely oblivious to what's building in the silver market. And here's something else that keeps me up at night. The financial system's dependence on silver for the green transition is creating a strategic vulnerability that very few people are talking about. What happens when governments realize that their entire clean energy agenda depends on a metal that's increasingly in short supply? That's when things get really interesting. You know, Charlie Munger, God rest his soul, used to say that the big money isn't in the buying or the selling, but in the waiting. And he was absolutely right. But waiting doesn't mean being passive. It means understanding the forces at work and positioning yourself before those forces become obvious to everyone else. Right now, we've got not one, not two, but multiple converging forces creating what I believe will be the perfect storm in silver. Let me walk you through them. Force number 1. The green energy mandate. This isn't just a trend or a fad. We're talking about governments around the world committing trillions of dollars to decarbonization. The European Union's Green Deal, America's Inflation Reduction Act, China's carbon neutrality goals, these are legislative mandates backed by real money, and they all have one thing in common. They're massively silver intensive. Solar energy is expected to grow from about 4% of global electricity generation to potentially 20-25% by 2040. Each gigawatt of solar capacity requires roughly 1 million ounces of silver. We're talking about installing hundreds of gigawatts over the next decade. You do that math, and you quickly realize we're talking about billions of ounces of silver demand that simply didn't exist a decade ago. But here's what really gets me excited and a little concerned. There's no plan B. I've read through countless government policy documents, industry reports, and strategic plans. Nobody's seriously planning for what happens if silver becomes scarce or prohibitively expensive. They're all just assuming the supply will be there when they need it. That's a dangerous assumption. Force number 2, the death of stockpiles. When I started in this business, governments held strategic stockpiles of all sorts of commodities. The U.S. had a strategic silver stockpile of over 3 billion ounces in the 1960s. Today, it's essentially zero. The Chinese government held significant reserves. Those are being drawn down. The COMEX warehouses, which are supposed to back the paper silver trading market, they're at some of the lowest levels we've seen in years relative to the size of the market. This matters more than most people realize. Stockpiles act as a buffer. When demand spikes or supply gets disrupted, you can draw down inventories to smooth out the market. But when those inventories are gone, there's no cushion. Any disruption, any demand spike goes straight to price. I'm old enough to remember the Hunt brothers trying to corner the silver market in 1980. They failed, partly because the government released stockpiles and changed margin requirements. Today, there are no stockpiles to release. The government's hands are tied. Force number 3, the mining reality. Let's talk about mining, because this is where a lot of people get it wrong. They think, well, if silver prices go up, miners will just produce more. In theory, yes. In reality, it's far more complicated. First, as I mentioned earlier, most silver comes as a byproduct. Miners aren't opening copper or zinc mines because of silver prices. They're doing it for the primary metal. Silver is just a bonus. So even if silver prices double, it doesn't necessarily incentivize much additional production. Second, ore grades are declining. Miners are having to dig through more rock to get the same amount of silver. This increases costs and environmental impact. Some of the richest silver deposits have already been mined. What's left requires more capital, more energy, and more time to extract. Third, and this is crucial, there's a massive capital shortage in the mining industry. After years of low prices and poor returns, investors are wary of funding new mining projects. The big institutional investors who used to back mining ventures are now pouring money into tech and renewables instead. This creates a vicious cycle. Low investment today means supply shortages tomorrow. I've looked at the pipeline of new silver projects, and I'll tell you, it's thin, very thin. Even if we had a dozen major new discoveries tomorrow, it would be 2035 or later before they're producing meaningful quantities of silver. Force number 4, the financial awakening. Here's something that doesn't show up in the supply-demand charts but matters enormously. Investor sentiment. Right now, silver is one of the most underloved assets in the financial world. The silver ETFs have seen outflows. Retail investors are chasing the latest cryptocurrency or AI stock. Institutional investors have largely ignored precious metals in favor of equities. But this is changing. I'm seeing it in my conversations with fund managers, in the positioning of sovereign wealth funds, in the quiet accumulation by family offices. The smart money is starting to wake up. When I look at silver's price relative to gold, relative to industrial metals, relative to equities, it's historically cheap. The gold to silver ratio has been hovering around 8:0 to 1 or even higher at times. Historically, that ratio has been closer to 5:0 to 1 or even 3:0 to 1. If silver just reverts to historical norms relative to gold, we're talking about significant appreciation. And that's before accounting for the supply-demand fundamentals I've outlined. Force number 5, the inflation factor. Now, I've never been one to cry wolf about inflation, but I'm also not blind to what's happening. Governments around the world have printed unprecedented amounts of money. The U.S. money supply expanded by over 40% in just a few years. The Federal Reserve's balance sheet exploded. Europe, Japan, China, everyone's been running the printing presses. This money has to go somewhere. For now, it's inflated asset prices, stocks, real estate, even art and collectibles. But eventually, it filters through to commodities and real goods. And when investors start looking for inflation hedges, where do they turn? Precious metals. Silver offers something unique. It's both an industrial metal and a monetary metal. It benefits from industrial demand growth and from investment demand as an inflation hedge. That dual nature gives it leverage that few other assets possess. The convergence. What makes this a perfect storm is that these forces aren't happening in isolation. They're happening simultaneously and reinforcing each other. Increased industrial demand draws down inventories, which makes investors nervous, which increases investment demand, which further tightens the market, which incentivizes hoarding, which creates shortages, which drives prices higher, which attracts more investor attention, and the cycle accelerates. I've been through enough market cycles to know that when multiple powerful forces align, the resulting moves can be far larger and faster than anyone anticipates. The dot-com boom, the housing bubble, the oil spike of 2008, these weren't gradual developments. They were explosions that caught most people completely off guard. The silver storm has the same potential. And unlike many of the bubbles I've seen, this one is rooted in genuine, fundamental supply-demand imbalances, not speculation or easy credit. So the question becomes, what do you do about it? How do you position yourself for what's coming? This is where my philosophy of investing really matters. First principle, don't speculate, invest. I've never been a fan of trying to time the market or make quick trades. That's not investing. That's gambling, and the house usually wins when you gamble. What I'm talking about is a strategic allocation to an asset class that offers compelling long-term value based on fundamentals. If you believe, as I do, that silver is entering a structural bull market driven by supply-demand fundamentals, then the approach is straightforward. Accumulate positions at reasonable prices and have the patience to let the fundamentals play out. Now, there are several ways to gain exposure to silver, and each has its trade-offs. Physical silver. This is the most direct approach, buying actual silver coins or bars. The advantage is that you own the real thing. There's no counterparty risk, no management fees, no possibility of paper claims exceeding physical supply. In a world of increasingly complex financial instruments, there's something reassuring about holding a tangible asset. The disadvantages? Storage and security can be issues if you're holding significant quantities. Premiums over spot price can be substantial, especially for smaller denominations. And liquidity can be less than ideal. You can't sell half a bar the way you can sell half your shares in an ETF. My view, physical silver should be a core holding for anyone serious about this opportunity, but it shouldn't be your only approach. Think of it as your insurance policy, the holdings you're prepared to keep for the long term through whatever market volatility comes. Silver ETFs and trusts. Exchange-traded funds backed by physical silver offer liquidity and ease of trading. You can buy and sell during market hours, just like stocks. The major silver ETFs, like SLV, are backed by physical metal held in vaults, giving you indirect ownership. The trade-off is that you're introducing intermediaries and counterparty risk. You're also paying management fees, albeit small ones. And in a severe shortage scenario, there are questions about whether all the paper claims could actually be converted to physical metal. I view ETFs as a tactical tool, a way to gain exposure quickly or to adjust your position size easily. But they're not a substitute for physical holdings if you're serious about this thesis. Mining stocks. Here's where things get interesting for someone like me who's spent a lifetime analyzing businesses. Silver mining companies offer leveraged exposure to silver prices. When silver goes from $25 to $50, a well-run mining company's stock might go from $10 to $40 or higher because their profit margins expand dramatically. But, and this is a big but, you're no longer just investing in silver, you're investing in management teams, operational execution, geological risk, political risk, and all the other complexities of running a mining business. I've seen plenty of companies with great assets fail because of poor management or bad luck. If you're going to invest in mining stocks, you need to do your homework. Look for companies with proven reserves and growing production, low-cost operations that remain profitable even if silver prices dip, strong balance sheets without excessive debt, management teams with skin in the game and a track record of execution, operations in stable jurisdictions. Don't just buy a basket of miners and hope for the best. That's lazy investing, and lazy investing usually loses money. Strategic royalty companies. One approach I particularly like is investing in royalty and streaming companies. These are businesses that provide upfront capital to miners in exchange for the right to purchase silver or other metals at reduced prices or to receive a percentage of production. The beauty of this model is that you get exposure to silver prices without the operational headaches of running a mine. The royalty company doesn't have to worry about labor strikes, equipment failures, or rising costs. They just collect their share of production. Companies like Wheaton Precious Metals or Franco-Nevada have built excellent businesses on this model. They're not pure silver plays, most have diversified into gold and other metals, but they offer a more stable, cash-generative way to participate in the silver story. The allocation question. People always ask me, Warren, what percentage of my portfolio should be in silver? And my answer is always the same. It depends on your situation, your time horizon, your risk tolerance, and your conviction in the thesis. But let me share how I think about it. I don't believe in extreme positions. I've never put all my eggs in one basket, no matter how compelling the opportunity. Concentration builds wealth, but diversification preserves it. You need both. For someone who believes the silver thesis as strongly as I do, I could see an argument for 5–15% of a portfolio in various silver-related investments. That's enough to make a meaningful difference if the thesis plays out, but not so much that you're wiped out if you're wrong. And always remember, you could be wrong. I've been wrong plenty of times in my career. The key is to structure your positions so that being wrong doesn't destroy you, while being right generates life-changing returns. The patience factor. Here's the hardest part, and it's where most investors fail. You need patience. This isn't a get-rich-quick scheme. The silver storm is building, but storms take time to fully develop and play out. There will be volatility. There will be periods where silver drops, and you'll question your thesis. There will be times when it feels like everyone else is getting rich in tech stocks while you're sitting on silver that's going nowhere. This is where temperament matters more than intellect. You can be the smartest person in the room, but if you don't have the emotional fortitude to stick with your convictions when the market is telling you you're wrong, you'll never realize the gains. I've held positions for decades that went nowhere for years, before finally working out. The key is to keep reassessing the fundamentals. As long as the underlying thesis remains intact, as long as supply remains constrained and demand keeps growing, temporary price weakness is just noise. The end game. Let me be clear about something. I'm not predicting that silver goes to $100 or $200 or some other specific number. I don't make price predictions because I don't find them useful. What I'm saying is that the supply-demand fundamentals are setting up for a significant repricing of silver. Could that mean silver doubles from current levels? Triples? More? I honestly don't know, and anyone who claims to know is fooling themselves. Markets are complex adaptive systems with countless variables. What I do know is this. The current price of silver doesn't reflect the reality of the supply-demand situation. It doesn't reflect the industrial consumption growth that's already baked in. It doesn't reflect the inventory drawdowns that are accelerating. It doesn't reflect the mining challenges that will constrain supply for years to come. When markets finally wake up to these realities, and they will, the adjustment will be swift and dramatic. That's not a prediction. That's just how markets work. They ignore fundamentals until they can't, and then they overreact. Final thoughts. The silver storm has already started. The winds are picking up, the pressure is dropping, and the early signs are all there for those who know how to read them. Most people won't see it until it's too late, until silver has already doubled or tripled, and the mainstream media is breathlessly reporting on the silver shortage. By then, the best opportunities will be gone. I've built my entire career on a simple principle. Be fearful when others are greedy, and greedy when others are fearful. Right now, almost nobody is talking about silver. The fear isn't there, but neither is the greed. It's that rare moment of investor indifference that creates the best opportunities. The question you need to ask yourself is, am I going to be one of the people who sees this coming, or one of the people who reads about it afterwards and wishes they'd paid attention? The choice, as always, is yours. But don't say I didn't warn you. The storm is here. The only question is whether you're going to take shelter or take advantage. Thank you for listening. Now get out there and do your own homework. Don't take my word for it. Verify everything I've said. Look at the numbers yourself. Read the reports. Talk to industry experts, and then make your own decision. That's what investing is all about.